Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Wednesday, the 3rd of July, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term intraday technical outlook for today on the broad-based cross asset classes, that means i.e. the major dollar pair, the major stock indices, two key commodities, that is i.e. gold, XAU/USD, and West Texas crude oil. Let's have a recap what has taken shape yesterday and even in today's early Asia session in terms of relevant news flow, economic data releases, and how does it impact the movement or the performance of the short-term, we call it volatility in these major cross asset classes. So let's start with yesterday's key economic data releases first on my calendar. So yesterday we do have a key economic data release which is out from Eurozone. So during the yesterday European session, we have the core inflation rate in Eurozone that is out at 5 p.m. Singapore time. So it came in almost unchanged, the same rate of data that was printed in the month of May at 2.9% year on year, slightly above market expecting at 2.8%. So net overall, if you look at the trend of the core inflation rate in Eurozone, it seems to us that in the last month of May and June, the current rate of the we call it acceleration that has taken shape in July last year, so that's close to about a 12-month period, seems to start to plateau off. So if you look at the 5-year trend, okay, it seems to have a little ink up or a potential V shape that is forming, or I would say a shallow U shape. So net overall over here is that inflationary trend may starts to actually plateau out in Eurozone as well, very similar to what was seen earlier on in Canada and Australia. That actually potentially could actually lead to the much more cautious stance of central bankers to start very aggressive interest rate cut. Do not forget, Eurozone has already started to cut its interest rates much earlier than the Fed 2 months ago. But given the fact that unless there's more evidence that the core inflation rate in Eurozone starts to its path of deceleration towards the 2% level, then we will start to see much more aggressive interest rate cuts up from the Eurozone. So something of a very, we call it a phenomenal that we start to see across the globe. Firstly, we start to see Canada inflation rate starts to tick up, Australia one as well. So very quickly, let us go to, since we are talking about this situation over here, very quickly in the economic calendar, right, in trading economics, we can just take a look at across the globe where are all the inflation trend to be. So we look up in Australia over here. So very quickly, let's go to Australia. So if we go to over here, the inflation rate, let's go to the inflation. This is the quarterly one. So for Australia, they do have a monthly CPI indicator as well. So if you look at the monthly CPI indicator, this is what I mean. Previously, it starts to plateau. Then for the month of May, it starts to tick up. Okay, so it's not showing a clear signs of deceleration as well. Okay, then the next one over here, if you go to Canada, over here, inflation rate. Okay, so for Canada, it's easier because they do have the monthly one rather than the quarter one. So you go to inflation rate over here. Let's take a look at core inflation. Okay, you look at the core inflation as well. It starts to actually ink up as well in the month of May. All right. So net overall, right, this that means there is no clear path of deceleration. That means there could be some sign of stabilization of inflationary trend as started to see globally. Okay, the latest one we start to see in Eurozone yesterday. So what I'm trying to put across the message over here is that going forward from a medium term perspective, I would not expect to see the start of a very aggressive interest rate cut cycle. But yesterday, one thing pretty much consolidating from the big boss himself, which is Fed Chair Powell. Okay, the boss of the central bank bosses. Okay, this is how I put it. Okay, okay, let me highlight that news flow. Okay, over here. Okay, so yesterday there was a speech by Powell right before, right at the start of the US session, okay, at around 9:30 p.m. Singapore time. So he did offer a rather kind of I would say that it's still a mixed picture, but he sounded quite confident that the latest he did mention that the latest price data offers signs US is back on a disinflationary path, but he also has a balanced approach. That's what his colleagues are saying. Say that the Fed still needs more confidence to cut. That means he needs to see more data signs, more data that is pointing to this inflationary path. So nothing of a what I call a new, we call it a very shocking remark. So I would say still a balanced remarks, still keeping hopes of the inflation, at least one interest rate cut alive before 2024 ends done by the Fed. And don't forget the Fed, other than RBA, against the other, we call it developed nation central banks, the Fed is still lagging behind in terms of the interest rate cut cycle, because we start to see Bank of Switzerland, the Central Bank of Switzerland has already cut interest rate 2 times. ECB has already cut the interest rate as well, and very likely Bank of England will cut its interest rate right after the this Thursday, not right after, next month perhaps, yeah, next month or so, because this month itself is the UK snap election, which is on Thursday. We'll talk more about that tomorrow in our daily dose. How does it impact the pound and the euro sterling? Yeah, and the Bank of England will likely do so after the month after this month. All right, in terms of their interest rate policy to end a cut. So the Fed has been lagging behind because inflationary pressure, especially the services side of the thing, has been rather more elevated compared to the rest of the world. Okay, so given that it's rather a balanced speech yesterday from Powell, if you look at the CME Fed Watch 2, where this particular, for those who have followed my daily dose of market insight, this shouldn't be a big, we call it a big surprise to you, because I use this website, is free. And for those who first time hearing or seeing this website, you just go CME group, then you just type in CME Fed Watch, will be fine. Just Google it, CME Fed Watch. So what CME does over there, they compile the likelihood of what market participant is expecting, whether the Fed will cut or hike based on the price movement of the Fed funds futures interest rate. All right, the Fed funds futures interest rate. So they put it in tabular form, so very interesting, very easy to see. So what we could do over here is that they break down according to the various. Over here you see at the tab is the various respective date of the FOMC. So what's FOMC? Is the US Federal Reserve meeting date. They call it FOMC. All right, so just go down to probability over here. You're able to see the aggregator. All right, so what I could do over here, this conditional meeting probability. So what I could do, I will go down to the aggregated meeting probability. So this gives me a summation of probability. All right, so we know that right now the Fed funds rate is 5.25% and 5.5% at this point in time. So if you look at, this will be the July date. Okay, unfortunately I can't sort this date according to date, month, year. So they use the American style. The first digit you see is month, date, year. Okay, so this should be pretty much clear rather than, okay, so for this month of July, which is the 31st of July FOMC meeting, very high chance there will be no interest rate cut or hike, because market is looking at a 91% odds to maintain stand pat at 5.25% to 5.5%. Only a small chance of 9% chance of a cut to bring it down to 5.5% to 5.52%. So the difference is a 25 basis point cut, but very low chance. So the market is penciled in a very high odds, still no change. So this particular pendulum still remains the same around 2 months ago. And yesterday's Fed Powell balance speech doesn't change much the situation. So still maintaining at 73% chance of a first cut to come in September. Then thereafter, the next November month will maintain as unchanged. Okay, so right after the US presidential election in the month of December, 18th of December, there is also another high chance, which is now the market is looking at the odds of 77% for another 25 basis point cut to bring it down lower to 4.75% to 5.5%. All right, so net overall, based on the current CME Fed Watch 2, according to the latest data obtained from the Fed Funds Futures interest rate market, there is actually market participants is looking at least 2 interest rate cuts by the US Federal Reserve before 2024 ends. So that also allow the 10-year US Treasury yield that is being bombarded by multiple factors right now, influencing the situation right now, due to what I call a potential Trump coming back into the US, the White House, which could lead to higher inflation pressure in the long term. But meanwhile, in the shorter term horizon, we see the US Federal Reserve still maintaining its at least I would say one interest rate cut before 2024 ends. So that allows the US 10-year Treasury yield to still maintain below the all-important medium-term resistance level at 4.5%. All right. So given that it can't break above 4.5% yesterday, and if you look at the 2-year Treasury yield itself, which is the shorter term, much more sensitive one, it's also managed to maintain below this level here. Okay, the 50-day moving average, I think, as a resistance, and as well as this former medium-term channel support. Now it turns into a pullback resistance at 4.84%. So given that the US 10-year Treasury yield and the 2-year Treasury yield is being kept below their respective key medium-term resistance level, we do see a sideways movement of the dollar. So by looking at the US dollar index, it didn't actually move much yesterday. So price action, oops, it's a bit lagging. Okay, so price action of the dollar still continues to trade in a sideways range. Okay, yesterday at this point in time. So even though which I shared with you in my intraday daily technical outlook on the 4 major pair, even though it's trading sideways, there is still some signs of short-term dollar strength prevalent, especially against the dollar yen, which is still continuing to trade above the support level. And also, despite yesterday's intraday slight push up on the euro dollar and the sterling dollar, they still remains below their respective resistance. Okay, later I'll talk more about that and share more of that later when I go through the short-term intraday technical outlook. Okay, then on the other hand, over here is we do see some form of, we call it positiveness coming back into the US stock market as expected yesterday. So I could see as a very strong intraday performance. Right at the start, the market keep pushing up higher and higher. All right, on the S&P 500, the Nasdaq 100 as well, the top performer, up 1% yesterday. The Dow Jones slightly lower, which is up 0.4%. So the Dow Jones kind of traded sideways. It's only it managed to get that positive feedback loop at the start of the second half of the US session, which is at around 1 a.m. Singapore time, where you start to see that intraday V-shaped recovery to close near the high. And even the worst performing Russell 2000 in the past 1 year or so managed to actually inch up a slight gain as well at 0.19%. So what we could see over here is that the main driver to drive yesterday's rally in the US stock market has managed to come from the mega cap stocks. So thankfully, the other mega cap stocks like Microsoft, especially Apple, that drove to fresh all-time high, positive 1.62%, Google 1.15%, as well as Amazon a positive 1.42%, and Meta 0.95%. And we see a whopping, we call it a double-digit gain of Tesla that is up 10%. And do not forget, Tesla has been down for the year. I think if you look at the year-to-date return of Tesla, is still negative. Okay, I think it's negative double-digit. It's okay. Now it's managed to actually inch up higher. It's still down negative 6.9%. 0.93% year to date. Okay, so given a very low base scenario yesterday, I believe that yesterday Tesla do have some firm-based positive news regarding about their delivery, we call it, of EV vehicles that came in better than expected. So that explains its daily performance. So all these mega cap stocks over here, Amazon, Meta, Google, Apple, Microsoft, managed to offset yesterday's underperformance of Nvidia. So still recall, Nvidia is the number 2 biggest cap stock in the S&P 500 and the Nasdaq 100. All right, so net overall, we start to see a very strong performance on the S&P and the Nasdaq 100. Okay, despite the fact that the underperformance of Nvidia yesterday, because has been offset by other stellar performance of the other mega cap stocks. Okay, so now another news flow I'm sharing with you all yesterday is not today, in fact today, is the worse than expected services data, PMI data, the Caixin services PMI data that is out from China. So what you could see over here is that earlier at 9:45 p.m. AM Singapore time, pardon me, the Caixin services PMI data. So China is a bit strange. There are actually two what I call that compiler of this PMI. One is done by the National Board of Statistics, which is the government one, and Caixin is the privately compiled one. So what's the difference between Caixin and the MBS PMI, both in terms of the services and the manufacturing, is that Caixin consists of the SME, all right, whereas the MBS one, which is the National Board of Statistics of Government, that particular services or manufacturing PMI doesn't including in the SME. So I would say that the Caixin one will offer us a better picture of, or I would say a more comprehensive picture on the growth of the Chinese economy. So if you look at the services side of the thing, the services side PMI, that means the services activity in China start to slow down a fair bit. So previously it was at 54. Market is expecting to slow down only a bit of 1 point by 53.4, no, 0.6 point, 53.4. But however, the actual figure came in at 51.2. So if you look at the trend of the Caixin manufacturing PMI, all right, so in the last 3 to 4 months or so, it has been moving up speed since the start of this year. So the one in May itself was the strongest gain, okay, the strongest expansion, okay, which is 54 point, okay, since almost a year ago. All right, so now it seems to us that the expansion, the growth starts to temper off. So anything that is still holding above 50 is still considered expanding. So right now the pace of expansion has started to slow down in the month of June. So what it means that over here is, it seems to us that the services demand side of the story, which represent consumer spending or consumer sentiment, is related to more or less the internal demand side of the China economy, is not as rosy yet. All right, so since it's not as rosy yet, China require the external economy to maintain growth. Still recall that the China top policymakers has set a 2024 year-end target about 5%. And given the fact that the services PMI is now start to show signs of a slowdown in its expansion, the only way to actually starts to see a pickup if this expansion starts to slow down is the external demand got to be rosy or maintained. So that's via export growth. So in order to do that, there's a chance or likelihood that in order to boost export growth, the CNH, the Chinese yuan, may weaken further. Okay, so now back to the fundamental. Now it's the first step of the intermarkets and the fundamental dynamics. So let me touch more about how does the yen right now, the Chinese yuan, impact the China stock market and as well as the Hong Kong stock indices. All right, so with that, we know that the services PMI growth has started to slow down. That means, i.e., internal demand in China is not so rosy. In order to meet that 5% growth target set by top policymaker in China before 2024 ends, the external demand side of the story needs to be maintained in terms of growth. And how do we maintain that? That we need to get more export growth. In order to get more export growth for China, one of the way is to weaken the Chinese yuan. So if you look at the Chinese yuan over here, it has been gradually weakened since the start of June. All right, since the start of June over here, okay, it starts to inch up higher and break above this key swing high area that was seen on March and April this year, they can't break. And this dollar CNH, the Chinese yuan, broke above 7.227. So overall, if you look at the Chinese yuan over here, right, or the dollar against the CNH, this offshore yen, is still evolving in a major uptrend phase. All right, okay, major uptrend phase. Okay, so over here, if I go to the weekly chart, you could see it very, very clearly. Okay, okay, the major trend is still intact. And if you recall, this was the big spike up earlier on in October 2022 over here. So this also coincide with the lockdown. Okay, then thereafter, after the reopening, it starts to come down again. Thereafter, it starts to go back up again, and thereafter, it tries to trade within this sideways range for a very long period of time, almost close to what 14 or 16 months, where the China PBOC tries to smooth down the yen depreciation against the dollar. And given the fact that the dollar CNH over here, and if China wants to boost its external, we call it demand, that means via exports, one way to do so over here is to make the yen cheaper. That means the dollar CNH will actually appreciate at a faster rate against the Chinese yuan. That means this particular chart here will keep moving up but at a slower pace, right? But we know that over here, if it continues to goes up over here, that means we start to see uh dollar strengthening against the Chinese yuan. It could actually see a negative feedback loop into the China stock market by looking at this correlation chart. All right, so let me plot this correlation chart for you. Okay, so take a look at it. Okay, this is the China Enterprise HSCI, Hang Seng Index, and the CSI 300. Okay, so this purple line here, what I did over here is inverted. So instead of $1 US dollar equals to how many CNH, I plot 1 CNH equals to how many dollar? That means dollar per CNH. So we know that over here is that if the CNH starts to weaken, that means the Chinese yuan starts to weaken, it will lead to a direct negative correlation on the Hang Seng Index. That means the Hang Seng Index will weaken as well, together with the CSI 300 and the Hang Seng Index over here. Okay, so recently it starts to plateau off, it starts to trade sideways. Okay, it starts to trade, it went up slightly. Okay, but right now the index has the CNH starts to depreciate against the dollar again. That means the CNH weakening. This is the inverted one. Okay, it came down, and bear in mind that over here, since it came down over here, the Hang Seng HSCI also starts to trade lower as well. Okay, over here. Okay, followed by the CSI 300 that is inching downwards, and as well as the Hang Seng Index. Okay, that has starts to inch down much lower as well. So then overall, right, what we could see over here is that if the Chinese yuan continues to weaken against the dollar, it could has a negative feedback loop into the Hang Seng indices and as well as the China stock index, which is the CSI 300. So net overall, right, what we could see over here is in the medium term, that means if the dollar continues to strengthen against the Chinese yuan, due to the fact that the China policy maker needs to do that, if the internal demand of the China economy doesn't pick up, that means as being shown by a growth slowdown in the services PMI, where I showed you all, in order to offset that, the external demand growth got to be maintained. That means via export growth. And one way to maintain the growth of the export growth is to weaken the yen. And that could actually see a medium-term negative feedback loop back into the stock market. That means the China stock market and the Hang Seng indices, right? So that's the fundamental intermarket dynamics, a more of a medium-term perspective that I'll share with you all if the weaker Chinese yuan starts to persist going forward. All right. So with that, now let us now jump straight into the short-term intraday technical outlook on the cross asset, starting from the FX market first. All right. So with the starting from FX market, let us start with the euro dollar. But before that, let me expand my screen so that you guys could see over here. Okay. So this will be the euro dollar. Okay. So the euro dollar yesterday, right? We do have a, okay, sorry, where's the euro dollar? Sorry, my apologies. I think the screen is a bit lagging. Okay, hopefully it works fine right now. Okay, why is it not showing it? Okay, good. Okay, this is the euro dollar. So this euro dollar yesterday, we do have a short-term pivotal resistance zone at this 1.077/0790 over here. Okay, so during the European session, it came down and hit the first support level before bouncing up. And what we could see over here, yeah, is still managed to maintain below the 20-day moving average. Okay, so this pink line here is the 20-day moving average. And check it out, right at the 20-day moving average, it starts to shape a hourly shooting star and a bearish follow through at the start of the Asia session at 8 a.m. Singapore time and 9 a.m. Singapore time. Okay, so net overall, we still see some form of hesitance by the bulls to actually push the euro dollar higher. Okay, so no change since it's still remaining below the 20-day moving average, and as well as our key short-term pivotal support that we highlighted yesterday at 1.0770/1.0790. We'll still maintain that short-term intraday bearish bias on the euro dollar. First support level to watch will be at 1.0710, which is yesterday's minor swing low. And a breakdown below it exposes the 1.0666/0656, which is actually the medium-term symmetrical triangle range support from the low of 3rd of October last year. Okay, only hourly close above 1.0790 will invalidate today's intraday bearish bias to see the continuation of the corrective bounce, to see the next near-term resistance coming in at 1.0815, followed by 1.0850, which is the minor swing high of 12th of June. Okay, so that's for the euro dollar. Moving forward will be the sterling dollar. So the sterling pound or the cable yesterday managed to actually bounce up higher as well, but still can't break above the short-term pivotal resistance that we highlighted earlier at 127 figure, which is so the 20-day moving average acting as a resistance as well. So still no change, still use 127 figure level as my short-term pivotal resistance, still maintain that short-term bearish bias on the intraday basis for the sterling dollar. The first support level to watch out for today, okay, will be this level here. Okay, close to the 50-day moving average at this 1.2650 level. Okay, 1.2650 level. Breakdown below 1.2650 level potentially sees a retest on last Friday low. Okay, and as well as yesterday's low as well, which is at 1.2615 slash 1.2610 support level that we highlighted yesterday. Okay, so it's more like a range configuration, not a range bound configuration, but back towards the lower limit of this minor range lower limit of this minor range configuration, pardon me. Only hourly close above 1.26 figure level will invalidate today's bearish intraday bias on the sterling dollar to see a potential squeeze up for the next near-term resistance to come in at 1.2640, followed by 1.28 figure in the first step. Okay, so that's for the sterling dollar. Okay, now moving on to the Asia Pacific dollar pair, starting with the Aussie dollar. Still recall the Aussie dollar yesterday we do have a bullish bias to float up towards the top of its minor range resistance at 66.80. So right now in today's Asia session, it printed a high of 66.78, more or less has been met. So I will use the top of the range over here at 66.90 as my short-term pivotal resistance level. So flip to a short-term intraday bearish bias for today since it's coming to the top of this minor range over here. For the first support level to watch out for will be at 66.40, which is close to the 20-day moving average. A breakdown below 66.40 exposes the next near-term support at 66.20, which is the minor swing low of 28th of June, as well as conversing very closely to the 50-day moving average, acting as a support at a similar level as well. Only an hourly close above 66.90 will invalidate today's intraday bearish bias to see a much more residual push up to test the medium-term range resistance zone of 67.10 and 67.30. So for those who first time looking at my daily dose. Why the 6710 and 6713 is important? Because that's actually the medium term upper limit of that symmetrical triangle that is still evolving by the Aussie dollars on the daily chart since the low of 13th of October and the high of 3rd of February last year. And based on the upper limit of this descending channel, upper limit of the symmetrical channel, pardon me, is at 6710, 6730 as expressed or shown on the daily chart of the Aussie dollar over here. Is pretty clear for you guys to see, right? Now, dollar yen. So dollar yen, no change, continues to trade within this minor ascending channel that I drew from the low of 13th of June. So yesterday price action came down, almost hit the first support and bounces up and want to retest the 6180 first resistance that I highlighted yesterday. So I don't want to put it so tight at 61. Okay, so what I'm gonna do over here is that I will put it slightly higher now at 6110 level because it's now very closely to the upper limit of this channel, lower limit of this minor ascending channel. Okay, so let me remove this. Okay, let me tidy up. Okay, so the short-term pivotal support today will be at 6110. Okay, so as long as any pullback managed to hold at 6110 level, still maintain that short-term intraday bullish bias on the dollar yen, above 6180 exposes the next near-term resistance at 6240. Only hourly close below 6110, a breakdown below 6110, that means also a break below the minor ascending channel support, will potentially see a pause on this minor impulsive up move to potentially shape a much more deeper minor corrective decline scenario to test the next support level at 160.30 first over here. Okay, let me put it down in, oops. Okay, 160.30. Okay, a break below 160.30 exposes 159.90. That means that could see the deeper minor corrective pullback, but still within a short-term uptrend phase as it's still holding above the 20-day moving average if 6110 breaks down with an hourly close below it. Okay, so that's for the dollar yen. Okay, now with that, let us now move on to the short-term intraday technical outlook on the major stock indices, starting with the Asia Pacific Stock Index first, with the Nikkei 225 or the Japan 225. So what we could see over here is that the Japan 225 very strong push up, so that came within our expectations since last week. So price action starts to hit the resistance level that we highlighted at 40,230. Okay, so this will be my first pullback support over here. So what I could do over here is that I will actually don't want to tight so tightly, so I will use yesterday's low area, 39,860 area. So potentially, because right now you see the RSI, okay, is at the overbought level. Okay, so but no signs of a very bullish exhaustion. Why? Because the RSI continues to see a higher high, rather not a lower higher. Okay, so no bearish divergence. That means, i.e., the trend still remains intact over here. So, but however, there could be a signs of a first pullback towards 40,230, given that it's at the overbought level. So, I'll use a slightly lower level at 39,860 as my short-term pivotal support level. So, this short-term pivotal support level will be my Titan key short-term pivotal support to maintain the intraday bullish bias on the Nikkei 225 or the Japan 225. Next resistance level to watch will be at 40,760, followed by 41,000 / 41,055, which confluence with the Fibo extension level, and as well as the minor swing high of 27th of March. Only an hourly close below 39,860 will invalidate today's intraday bullish bias on the Japan 225 to see a much more deeper minor corrective pullback to retest 39,445, which was last week minor swing low, and potentially even 27th of June minor swing low at 39,220, which is coming close to the rising upper sloping 20-day moving average as well. That is confluencing very closely to 39,220. Okay, so that's for the Japan 225. Okay, now moving on with the Hang Seng Index or the Hong Kong 33 Index over here. So the Hong Kong 33 Index, let me Okay, so yesterday we do have a bullish bias as well. Okay, at 80,010 level. Okay, so with that over here, the price action starts to hit the 1810 level over here, and it seems to us that the hourly RSI also continues to inch much higher, shaping a series of higher high as well. Okay, so at least in the short term over here, despite the fact that in the medium term basis, we do see a potential weakening of the Hang Seng index, given that if the Chinese yuan starts to get weaker, as I show you in the more medium term intermarket dynamics at the start of the daily dose. But the short term momentum continues to play out rather strong at this juncture. So potentially, right, what we could see over here is that, okay, let me tidy up the chart for you guys to see. Okay, 18,010 level over here. So if you start to see a breakout above 18,010, potentially the Hong Kong 33 index could actually maintain this intraday bullish bias to retest or seek a test on the next near-term resistance at 18,240 next, which is the minor swing high area of 24th of June and 25th of June, and as well as the 50-day moving average also conferencing at a similar resistance level at 18,240. But I don't want to tight it so tight my short-term pivotal support level that we have yesterday. So still maintaining at 17,600 level over here. Okay, so this will still be my short-term pivotal support level. All right, so as long as 17,600 holds, then break down below it, still maintain that short-term bullish intraday bias only on the intraday basis on the Hong Kong 33. A break above 18,010 potentially exposes the next near-term resistance at 18,240. Only a breakdown the hourly close below 17,600 level will invalidate today's intraday bullish bias on the Hong Kong 33 to see the index floating down much lower to test the next near-term support at 17,460. A breakdown below it exposes the important critical support of 17,170. Why? Because it's the 200-day moving average, as well as the former minor swing high area of 13th of June and 10th of April that broke out, that kickstart that former steep rally from 25th of April and late May. Okay, that was seen previously. Okay, so that's for the Hong Kong 33. Now, moving on will be the German DAX itself, all right, or the German 30, we call it. So the German DAX over here, or the German 30 in our platform, managed to actually inch down lower and hit our support level yesterday and shape a minor bounce during the end of the US session. So overall, it's still reintegrate back below the 20-day moving average that is still sloping downwards, and after inflicting off from the 50-day moving average that's acting as a resistance area. So net all in all, it starts to actually erase that earlier pop-up that was related to the ex-post of first France parliamentary election result that were released earlier on Asia session on the Monday. So net overall, what we could see over here is that there is still no clear signs of what I call a strong bullish reversal or a recovery scenario that is taking shape on the German DAX or the German 30. So with that, we will still maintain a short-term intraday bearish bias within this kind of very complex sideways range configuration, minor sideways range configuration on an intraday basis. So I want to tighten the short-term resistance so tight. So the first short-term resistance that could watch out for will be this level here, which was the gap, okay, that was filled and hit below it. Okay, at 18,270, but I will still use 18,370, which was the failure breakout, as my short-term pivotal resistance for today. So as long as price action didn't surpass 18,370, we'll still maintain that short-term intraday bearish bias on the German 30. First support level to watch for sure will be this complex minor range support level at 18,085 slash yesterday's intraday low is 18,040. All right, 18,085 slash 18,040. Okay, however, only an hourly close above 18,360 then will invalidate this short-term intraday bearish bias to see a kind of a residual push up to test the next resistance at 18,520. We also correspond to this descending trend line that I drew from the all-time high area from 16th of May. Okay, that's for the German 30. Moving on now will be the US stock indices, starting with the Dow Jones Industrial Average or the US Wall Street 30. So for sure, no change yesterday. This is indeed a key magnetic pivotal support level where price action came down and bounced off it, right? And still can't break the first resistance at 39,600 that I highlighted earlier on. So still no change to use 39,090 slash 38,945 as my short-term pivotal support level to maintain the short-term intraday bullish bias on the US Wall Street 30. First resistance to watch 39,600, only a breakout above it exposes the next resistance at 39,790, which is this minor congestion area of 21st of May and 22nd of May. When an hourly close below 38,945 will invalidate today's intraday bullish bias on the US Wall Street 30 to see it floating down to expose the next near-term support area at 38,730 followed by 38,560 slash 38,420 next. All right. 1 second, give me a minute. So I believe that everyone could hear me speaking, right? Okay, mic test 1 2 3. Okay, good. Okay, good. Okay, all good, all good. All right. So the laptop issue is good. All good. Thank you so much. All right. So now moving on will be the Nasdaq 100 over here. So the Nasdaq 100, what we could see over here is that continue to inch higher. With that, it start to shape a higher high and higher low, and being supported by this rising 20-day moving average. The RSI, yes, is hitting the overbought level, but there is no signs of a bearish divergence. Okay, so I could see is that the index continues to shape higher high. The RSI, okay, not the RSI continues to shape higher high in line with the index price of the index. So what I could see over here is that given that the RSI really hit the overbought level, there could be a minor pullback over here for today. So given that it starts to see a series of higher high, I will tighten today's short-term pivotal support level for the Nasdaq 100 at yesterday minor swing high, now turns into a pullback support, and very clearly this is all a congestion area over here at 19,850. So as long as this tighten 19,850 short-term pivotal support holds in any potential minor pullback, we'll still maintain this short-term intraday bullish bias on the Nasdaq 100. Next resistance zone to watch out for will be 20,120 slash 155, followed by 20,260 slash 20,360, which is a confluence of a Fibo extension level. Okay, only hourly close below 19,850 then will negate today's intraday bullish bias to see a steeper see a deeper minor pullback to retest this Monday minor swing low area at 19,620 slash 19,507. We saw confluencing with the rising 20-day moving average that is acting as a similar support level as well. Okay, within this next near-term support zone. Okay, if 19,850 gives way for today. Okay, so that actually sum up for the intraday technical outlook on the major stock indices. Now let us move on to the commodities, starting with gold, XAU slash USD. So no change for gold, still continues to trade within this range at 2,344, which confluencing with the upper limit of this minor descending channel that is in place since its all-time high of 20th of May, and the lower limit at 2,318 that has held since last Friday. So still maintain that neutrality stands between 2,344 and 2,318 for today on gold XAU slash USD. Okay, now lastly will be let us go to the oil market, the West Texas crude oil over here. Okay, let me open up the chart of West Texas crude oil. Okay, so West Texas crude oil, 1 second. Okay, so no change as we expected. The price indeed did a minor pullback after hitting the first resistance at 84.40. So over here, the RSI now is coming back to some form of support level as well, as you could see over here. Okay, bouncing off from the support and indicating to us that some form of short-term intraday positive momentum is coming back into the West Texas crude oil. So no change, using this 81.90 here that I highlighted yesterday to maintain this short-term intraday bullish bias on West Texas oil. Above 84.40 sees the next resistance coming in at 85.05, followed by 86 figure level, which is close to the top of the upper limit of this minor ascending channel that I drew from 4th of June. However, only an hourly close below 81.90 will invalidate. Okay, let me delete this. Okay, will invalidate today's intraday bullish bias to kickstart a deeper minor corrective pullback to expose the next near-term support level at 80.60. Below it sees the 50-day, the 200-day, and the 20-day all coming to act as a support level at 79.45/78.90 next. Okay, so with that, that sum up today's intraday technical outlook on the key cross asset classes. So before we go, let's take a look at the economic calendar. What are the key data to look out for today? So for today, overall here, we do have the PPI data, the Producer Price Index from Eurozone for the month of May, coming out at 5 p.m. Singapore time today. And we do have one job data. So this job data is something like a prelude to this Friday non-farm payroll data. So this is compiled by the private sector, ADP. So the ADP employment change data for US will be out at 8:15 p.m. Singapore time, around 1 hour earlier, slightly 1 hour earlier than the start of the US stock market session. And thereafter, we do see rather quiet data, and this is another important data. Not quite, rather important data, pardon me, the US ISM Services PMI. Okay, so this data is important. Why? Because we know that the services activity in US constitute close to or contribute close to almost three quarter of US GDP. So the services PMI data will be a closely watched data to look out for at 10 p.m. and also keep a lookout for its subcomponent, which is the services prices paid. So that actually constitute what I call the cost of business or input costs for the businesses that is operating in the services sector in US. So something to pay attention to at 10 p.m. Singapore time today. And thereafter, we do also have one that is related to the US, I think, stockpile. Yeah, this is the weekly US stockpile, releasing at 10:30 p.m. Singapore time by the EIA, the Energy Agency of US. So that is for the week ended 28th of June at 10:30 p.m. That could impact the prices of the West Texas oil. So that will be at 10:30 p.m. Singapore time. And thereafter, that will be a rather quiet US session, except the fact that we see the FOMC minutes that will release at 2 a.m. Singapore time. So this shouldn't be a big surprise because more or less it will still showcase the rather balanced approach that currently the Federal Reserve officials are actually in favoring. That means, i.e., the usual stance. That means, yes, they are looking to cut rates, but they want more evidence to come into play before enacting the first interest rate cut. So that shouldn't be a big market mover on the FOMC minutes. Okay, so with that, that sums up today's Daily Dose of Market Insights, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.